Earnings season is important at both the sort of macro and the micro level for investors. We're looking at companies all around the world. At the macro level, we can take the aggregation of the earnings reports, and the earnings reports mostly consist of the revenue, the earnings per share, which is revenue less their costs, also some forward guidance and commentary from them on their sort of supply chain, demand, labour costs, how their world and their industry is doing. So at the micro level, it's very important on a per company basis to look at how they're going versus their plan, whatever their industry is, whether they're an accelerating, exciting new business that's growing fast or a mature company. They should have a plan, and the earnings season is an update on how that plan is progressing. And shareholders are, of course, rightly interested in whether the plan is going well, okay, or having some tough times. And then at the macro level, we do look to aggregate that up and compare that to sort of other high-level data such as GDP growth, and sort of assess where are we in that sort of overall market cycle in terms of economic growth, inflation, and interest rates. So we're looking at this from both the top down and the bottom up. The first quarter of 2025 earnings season was pretty positive. You'd give it a sort of B+, A- if it was a report card. In the US, as has been the case for the last few years, it was the strongest, sort of pro forma earnings growth, low teens, 13% year-on-year growth from the quarter 1 year ago. And as with previous sort of years, that was mostly led by those mega cap companies, the Magnificent Seven. The earnings pro forma earnings growth there of above 25%. That means the broader sort of US market was more like sort of 9-10%. But that's a pretty solid report. In Europe, a little bit less muted, and the expectations there were a lot lower. Expectations were actually for a slight decrease in earnings. So that earnings season was above expectations, and expectations are important as much as the overall level. So the overall European earnings season came out at 2 or 3% earnings growth, so that is above the expectations for a slight decrease. So in both cases, the earnings season was viewed pretty positively. However, as with everything at the moment, there's a caveat that comes with that sort of Q1 result, is that most of that revenue, costs, earnings per share was before the global tariff sort of reduction set off. April the 2nd was the famous Liberation Day, where the US administration announced these big proposed drastic overhaul of the global trade system. So there is still a lot of uncertainty, and when we think about that other part of the earnings season that we look for forward guidance, that's where it's a bit unusual. We're back to early 2020, where companies are unable to give clear forward guidance because they just don't have that certainty on what all those important inputs, the costs, the labour costs, the transport costs, what those are going to look like, because we know that the proposed tariffs have been delayed for 90 days, but that 90 days is sort of fast expiring. So even before Liberation Day, there was a rather infamous change to the US-Canadian steel tariffs that went up from 25 to 50%, and then less than 6 hours later was reduced back to 25%. So when you're asking companies to give us some guidance, they're quite rightly saying we cannot change our guidance because we do not know what the rules of the game are going to be. So we're in this, in terms of the forward guidance part of the earnings season, the number of companies giving forward guidance, I think in the US it was down to 16%, normally about 40-50%. And again, if we compare that to COVID, it was sort of right down to 10%, where there was so much uncertainty they were unable to sort of give a clear vision for the next few quarters for their business. Aside from that uncertainty around tariffs, there was some good news again at the aggregate level for the earnings season. In the US, the labour market there is a very important part of that, the economy, of course, as it is everywhere, but companies have been sort of reluctant to let workers go despite that uncertainty. The experience after the COVID lockdown, it was, if you had let some staff go due to short-term problems, it was actually quite difficult to get them back. So that US labour market is still quite tight, so companies are being patient, which is good for overall employment statistics and good for overall demand from those consumers. And a similar picture in Europe, where job growth is starting to pick up with some of those big initiatives announced by the European Union, and in particular Germany, on sort of defence spending, climate change and infrastructure. So some good news there at the sort of employment and overall sort of jobs markets. Interest rates is the other one, where interest rates have come down a lot, and so companies are still benefiting from lower borrowing costs. So again, if you think about it, most companies are two big cost items are wage costs and interest costs. So those interest rates have come down, still quite high in some parts of the world. The longer end of the yield curve elevated, but more central banks expected to cut around the world. So there is some sort of likelihood of lower interest rates as we look forward. So some positives there at the macro level. The answer at the moment would be there's many. In a more normal economic cycle, some of the classic bellwethers might have been the likes of FedEx and UPS, as in, how much stuff is getting moved around the world and how are those freight companies in New Zealand, main freightways, so same sort of thing. How much stuff has been moved around the world and how busy are those companies would have been a classic bellwether. At a time like this, with this huge tariff uncertainty, there's a lot of sort of different sectors that are going to be differently affected, and we're interested to dig into how these tariffs unfold as it relates to them. So think about the classic consumer sectors. You've got consumer staples, often made a little bit closer to where they're bought. If you're sort of thinking about rules of thumb versus, say, consumer discretionary, so think about apparel, either luxury apparel or sort of leisure wear, sportswear, so Nike, Under Armour, Adidas, your luxury goods, LVMH and Burberry, Hermes. They've all got slightly different supply chains, often heavily reliant on Southeast Asia, Vietnam, Bangladesh, China, but all to a different degree. And with these tariff sort of changes, there will be sort of winners and losers in that supply chain, and how those companies can handle this uncertainty, this new world. You can put up your prices if your end customer will pay it, or you can take a hit to your increased costs and take a hit to your revenue line. So we're looking at, interested to see how companies handle this uncertainty and what they do with their supply chains. And again, it does, history sort of never repeats, but it does rhyme. It has got echoes to COVID, where over decades, having built these theoretically optimal supply chains, just-in-time inventory management, the big lesson from COVID was that, what if we had a lockdown? And now we've got this, what if different parts of the world became more expensive to do business with? So that's the sort of stuff companies are grappling with at the moment, and that's what we're interested to see how they can handle that at the company level.